There's a date sitting somewhere on your calendar right now that you have probably never marked, never thought about, and possibly never even heard of. And yet, it is one of the most financially important dates of your entire retirement. It is not your birthday. It is not the day you filed for Social Security. It is the day the federal government stops letting you decide when to take money out of your own retirement account and starts requiring you to do it on their schedule, whether you need the money or not. And if you miss that date, the penalty is not a late fee. It is not a small inconvenience. It is one of the harshest financial penalties still on the books in the entire United States tax code. My name is Finn Whitfield, and this channel exists to make sure you are never blindsided by a rule that was sitting quietly in the fine print the whole time. If this is your first time here, hit that subscribe button right now before we go any further. Every single week on this channel, we walk through the exact rules, deadlines, and penalties affecting retired Americans in 2026 in plain English, with no jargon and no fear-mongering. Today's topic is one of the most consequential rules in the entire retirement system, and it applies to nearly everyone who has a traditional 401k or a traditional IRA. So subscribe, stay with me, and let us walk through exactly what this rule is, exactly when it applies to you, and exactly how to make sure you're never the person who finds out about it the hard way. The rule is called the Required Minimum Distribution, or RMD for short. When you put money into a traditional 401k or IRA during your working years, that money grew completely tax-deferred. You did not pay income tax on your contributions or on any growth along the way, but the government did not give you that tax deferral as a permanent gift. They gave it to you as a deferral, meaning eventually they expect to collect the income tax that has been building up in that account for potentially decades. The required minimum distribution rule is how they make sure that happens. Once you reach a certain age, the IRS requires you to begin withdrawing a minimum amount from these accounts every single year, and that withdrawal is taxed as ordinary income the year you take it. Here is the specific age that matters most. Under the Secure 2.0 Act, if you were born between 1951 and 1959, your required minimum distributions must begin the year you turn 73. If you were born in 1960 or later, the age moves up to 75. This is the single most important number in this entire video because it tells you exactly which calendar year the clock starts ticking for you personally. There's a timing detail that trips up more retirees than almost anything else in the system. Your very first RMD does not have to be taken by December 31st of the year you turn 73. The IRS gives you until April 1st of the following year. That sounds like good news, but here's the catch. Every RMD after that first one is due by December 31st of that same year. No extensions. If you use that April 1 extension for your first RMD, you will end up taking 2 required minimum distributions in the same calendar year. The delayed one plus the current year's regular RMD. Both count as taxable income in that same year, which can push you into a noticeably higher tax bracket and even affect how much of your Social Security becomes taxable, or what you pay for Medicare premiums. For most retirees, taking that first RMD by December 31st of the actual year you turn 73, rather than waiting for the April extension, results in a smoother and more predictable tax situation. It is worth discussing with a tax professional before you decide which approach fits your specific numbers. So, how is the required amount calculated? You take your retirement account balance as of December 31st of the prior year and divide it by a life expectancy factor published by the IRS in the Uniform Lifetime Table. That factor is based on your age and gets smaller as you get older, meaning the percentage you are required to withdraw increases slightly each year. Let me put a real number on this. If you have a traditional IRA with a balance of $400,000 at the end of the prior year and your applicable life expectancy factor is 24.6, your required minimum distribution for that year would be approximately $16,260. You can always withdraw more than the minimum. Withdrawing less is where the real danger begins. If you fail to withdraw your full RMD by the deadline, or withdraw less than the calculated amount, the IRS can charge an excise tax penalty on the shortfall, and it is severe. The current penalty is 25% of the amount you should have withdrawn but did not. Let that number sit for a moment. If your RMD was $16,260 and you withdrew nothing, you could owe a penalty of over $4,000. On top of the income tax you will eventually still owe when you do withdraw the money. This penalty used to be even harsher. Before the Secure 2.0 Act, the excise tax on a missed RMD was 50% of the shortfall, an almost unthinkable penalty that Congress recognized was excessive, which is part of why it was reduced. But even at the current reduced rate, 25% is still one of the steepest automatic penalties anywhere in the tax code. There is genuinely good news buried inside this penalty structure. If you catch the error and correct it within 2 years of when it was originally due, the penalty drops significantly from 25% down to just 10% of the shortfall. If you can demonstrate to the IRS that the shortfall happened because of a reasonable error, that you are taking reasonable steps to fix it, the penalty may be waived entirely. To request that waiver, you file IRS Form 5329, along with a letter explaining what happened and how you corrected it. If you discover you missed an RMD, do not panic and do not ignore it. Take the distribution as soon as you realize the mistake, file Form 5329 and explain what happened. Acting quickly is what separates a 10% penalty, or even a waived penalty, from the full 25% hit. Let me walk you through a situation that shows how this plays out in real life. Consider a retiree named Harold, 74 years old, living in Arizona. Harold built a traditional IRA worth just over $300,000 by the time he retired. He turned 73 the previous year, which meant his first RMD became due. He assumed his financial institution would automatically calculate and send it, but his account required him to actively request the distribution himself. December 31st came and went, and Harold had not taken any distribution at all. Several months later, while preparing his taxes with a new accountant, the missed RMD came to light. Harold's required distribution for that year had been approximately $11,000. Because he caught the mistake and corrected it within a matter of months, well inside the 2-year correction window, his penalty was reduced from what would have been a $2,750 hit at the full 25% rate, down to $1,100 at the reduced 10% rate. Still real money, but a fraction of what it could have been. Harold's situation is genuinely common, and it happens to careful, responsible people every year. There are a few important exceptions worth knowing. If you are still actively working past your RMD age, and you do not own more than 5% of the company you work for, you may be able to delay RMDs from your current employer's plan until the year you actually retire. This delay applies only to that current employer's plan, not to IRAs or previous employers' plans. Roth 401k and Roth 403b plans were exempted from required minimum distributions entirely, effective January 1st, 2024. This aligned workplace Roth accounts with Roth IRAs. Since Roth accounts are funded with after-tax dollars, the IRS has no future tax revenue to collect from them. There is one more strategy worth knowing. If you are 70 and a half or older, you can direct up to $111,000 for the 2026 tax year directly from your IRA to a qualified charity. This is called a qualified charitable distribution, and it counts toward satisfying your RMD without counting as taxable income to you. For a retiree with a $100,000 RMD who only needs $50,000 for living expenses, directing the remaining $50,000 to a qualified charity through a QCD satisfies the full RMD requirement, while keeping that $50,000 out of taxable income entirely. It is worth a conversation with your tax preparer if charitable giving is part of your financial picture. This is not a rule designed to punish retirees. Required minimum distributions exist because the tax deferral you received during your working years was always meant to be temporary, not permanent. And the RMD system simply ensures that deferred tax eventually gets collected. Here is what I want you to do. First, figure out your specific RMD age based on your birth year. 73 if born 1951 to 1959, 75 if born in 1960 or later. Write that year down. Somewhere you will actually see it. Second, if you are already past your RMD age, contact your IRA custodian or 401k plan administrator this week and ask them to confirm your RMD status for the current year. Many custodians will calculate the amount automatically or even set up automatic annual withdrawals for you. Third, if you are within a few years of your RMD age, talk to a tax professional now about how these distributions will affect your overall tax picture, including your Social Security taxation and Medicare premiums. Fourth, if your RMD exceeds what you need, ask about a qualified charitable distribution. And fifth, if you ever discover a missed RMD, withdraw it immediately and file Form 5329. If this video gave you information you did not have before today, share it with someone in your life who has a 401k or a traditional IRA and is approaching their 70s, a parent, an older sibling, a friend who retired around the same time. A share from you today could be the reason someone else never has to find out about this rule the hard way. Drop a comment below and tell me, did you already know your specific RMD age before watching this video? Have you or someone you know ever missed a required minimum distribution, and how did it get resolved? I read every single comment personally, so tell me your story. The next video on this channel is going deeper into the RMD conversation. Specifically, the mistakes retirees are still making with these mandatory withdrawals that are quietly costing them thousands of dollars every year, beyond just missing the deadline entirely. If you are not subscribed yet, hit that button now, take care of yourself, protect your retirement, and I will see you in the next one.